Hi guys, good morning and welcome to Trading Hour. I'm Pavitra Parekh. With me are Sumaira as well as Rima, and for the markets it is looking up right now. So we're seeing a good gain of over 90 points right now on the index, around 0.5% in the green. It is a mid-cap index in the banking pack which is once again leading the gain. So if you take a look at the mid-cap index, it's up around 245 points right now, so up 0.8%, and the Nifty bank index also holding up very well, seeing gains of 1% right now. It is led by the likes of Indices, SBI, ICICI, all of these doing extremely well. What's also holding up really nicely is the rest of the Asian pack. So take a look at the Hang Seng markets, for instance, that is up almost 2% right now, and it's sort of held onto those levels all through the morning. 2.5% on the Hong Kong markets. A bunch of them are closed, but everything that's trading in Asia is doing quite well. For our own markets, in addition to banks, you're seeing the cement pack really seeing good gains come through. So, and this is after 2 days of already strong gains, right? So some of the larger ones are on your screen: Shree Cement, Ultratech, Grasim. In fact, let's take a look at how these stocks have performed for the past 5 days. So Shree Cement is up over 20%. You have an Ultratech which has seen a gain of 7%. Grasim also up around 6%. So this entire sector definitely looking good this week. In addition, also take a look at the steel stocks, and some of the metal names are doing very nicely. So whether it's a Hindalco, Tata Steel, these ones are holding up well in this market. On the downside, Reliance is a little bit subdued today. And we have seen that pretty much through the week. IT also seeing some cuts today. So some of the larger names will be up on your screen. Very, very minor gains coming through there. And also you have some of the PSU stocks, so the likes of Power Grid, Coal India, which are a little bit under pressure. But, you know, out of the Nifty pack, there are perhaps 5 stocks which are in the red. So this is quite a broad-based recovery that we've seen overall, Sumaira.
Hi, Pavitra and Rima. Morning. So let's tell you all that we have for you on the show today. Indices edge up after a strong start. Mid-caps are outperforming. Metals, FMCG and financials charge ahead, while it's IT and realty that are the laggards today. We'll talk about the market fundamentals with Devang Mehta of Centrum Wealth Management.
Cloud has been a key driver for IT companies, a strong growth over the last few years. But are we headed towards a slowdown? A detailed explainer is coming up for you on the show. We will also be joined by Ravi Menon of Macquarie Group to discuss the way forward for the sector.
And with a host of big movie releases lined up for this month, what does the future look like for movie exhibitors? Will demand make a comeback? We'll talk with Karan Taurani of Elara Securities on this and lots more. Of course, there's a lot more lined up for you over the next 16 minutes as well. All right, but first, let's start off by focusing on the IT space. Cloud has been a key driver for IT companies, a strong growth over the last few years. But are we headed towards a slowdown? Rima is standing by with all the details on the big wall. Rima.
Thanks so much for that. So cloud, as you pointed out, was a key driver for IT companies' strong growth over the last few quarters. IT companies roughly earn about half of their revenues from digital solutions, most of which is directly linked to cloud offerings from hyperscalers like AWS, Microsoft Azure, Google Cloud. While the growth of these companies is still very, very strong, there are some signs of slowdown which are emerging. Ambit says cloud moderation indicators are emerging, though not fully conclusive. Let's break this up into 3 brackets. First, hyperscalers like AWS, Cloud, Google Cloud, that is, Microsoft Azure. Second, the SaaS companies. And third, the equipment providers to cloud companies. So starting with the hyperscalers. Now, hyperscalers' growth has slowed down in the current quarter. Take a look at the numbers of Amazon Web Services and Google Cloud. In the quarter ending June 2022, that's the current quarter, revenue growth for Amazon Web Services was up 33% on a year-on-year basis, but it's lower than the 37% growth that it had in the March quarter. Similarly, for Google Cloud, revenue growth slowed down from 44% to nearly 35% on a quarter-on-quarter basis. Secondly, even SaaS companies are warning of some slowdown, and there have been some guidance cuts, worries about elongated sales cycles. So one of the companies, Salesforce, trimmed its full-year revenue guidance by 200 basis points to 20% constant currency revenue growth versus 22% earlier. ServiceNow, another company, trimmed its full-year revenue growth guidance by 50 basis points. And other companies like Zendesk, Duck Creek, Pega, they're all warning of elongated sales cycles. And finally, the third leg of this, these are the equipment suppliers to cloud companies like Seagate. And Seagate just last week downgraded its Q1 FY23 revenue forecast. The company said incremental weakness on enterprise side was seen due to a cautious buying behavior among global enterprises, OEM, and certain US cloud customers. So the question that we're now asking is, why is the current macro slowdown that we're currently in impacting the IT companies, the software companies, the tech spending? Well, let's just take a step back. Now, post-COVID, clients opened the floodgates for discretionary spending to accelerate for cloud migration, digital transformation initiatives. But after 12 to 18 months of accelerated spending on technologies, the current uncertain macro has made enterprises take the foot off the pedal. Enterprises have now renewed their focus on cost savings and programs which generate a quick ROI, return on investment. Even as the digital transformation over the longer term, the initiatives still continue with full swing. But now what's happening is that tech budgets are receiving higher scrutiny. They require a greater level of approvals from the CFO office, C-suite, or even the board. And this is resulting in slower decision-making and longer deal cycles than we've seen in the past for software companies. Even in segments which were perceived to be relatively resilient, like data analytics, low-code, and automation. And as I said that, while there are certain red flags which are emerging, broadly, the enterprise market still remains very, very resilient, and digital transformation journey is continuing and even strengthening in a few cases. So the long term is still perhaps very much intact. But the question is, if there's really a broad-based slowdown in the enterprise level decision making and it gets worse, can the Indian IT companies remain immune, or will there be a trickle-down effect? Let's tell you the read-through from Indian IT. Kotak says that they believe tech spending, that is a function of the natural growth in business, can be impacted in a weak demand environment. For example, cloud consumption growth can decelerate, not necessarily because clients are slowing down cloud migration or their digital initiatives, but due to a lower storage or compute requirements in the case of an economic downturn. Vendors too, the vendor commentary indicates that digital transformation trend will only continue. So they're saying that FY23, we're unlikely to see a slowdown, but there could be a deceleration in growth FY24, which is something the street is already expecting. Back to you.
All right, Rima, thanks a lot for taking us through all of those very interesting details. In fact, we also have a guest joining us now. Ravi Menon is joining us from Macquarie. Ravi, good morning, and thanks a lot for joining us. This is Pavitra. So you just heard the entire presentation that Rima put out, and you know what? We were just talking about the kind of contribution that we get from cloud for a lot of these companies. While we're not seeing a very significant slowdown right now, do you think in the future it could get even more pronounced? And then what is the kind of impact that it could have on Indian IT?
I think this is excessively bearish. I think our Asia Tech team actually revised up its cloud capex guidance. So we are looking now at 22% growth in capex. And usually cloud capex has always been followed by revenues. So revenues track that pretty much, which would make sense, right? Because you put up the servers and then rent them out afterwards. So I think that if we are looking at a slowdown in calendar year 23 in cloud revenues, you would have actually seen a slowdown in capex, and we are actually instead seeing an acceleration in capex. So I think that we actually should expect to see good cloud revenue growth even in calendar year 23, that is FY24 for us. And we are actually still seeing enterprise hardware spend on PCs and laptops be pretty strong. Dell in its recent results actually had only worries on it actually saw declines on the consumer side, but its enterprise laptop and PC sales are up 15% year on year. And enterprise server networking revenue is up even higher, 16% year on year. So I think enterprises generally make cuts to hardware first because that's a easier postponement in spending without an impact to deliverables at your promised business. So I think that without seeing a cut in this kind of hardware spending, very difficult for me to see a cut in IT services spending. And as far as software, we've heard of that. So I think that while these are all very large firms, you should look at the long tail of clients. I mean, beyond the Fortune 1000 that Indian IT services firms cater to. So I think the small and medium business market, the SMB market, is what Salesforce actually has a large exposure to, apart from the large enterprises. So I think we can't really correlate, what happens to a company like Salesforce with thousands of customers versus someone like, say, a TCS, where probably what happens to the top 100 or 200 customers matters a lot more.
So you're still very, very optimistic. Can you tell us what is your forecast for growth FY23, FY24 and thereafter? So the street is expecting some slowdown will take place in FY24 because of the current situation. The base effect as well kicks in. But what about thereafter? Because markets tend to price in, say 3 years, 5 years out hence in growth.
Right. I think that FY24 and FY25 estimates, especially for TCS, look excessively bearish to me. When I look at growth estimates, for this year, in constant currency terms, we are looking at 14% growth. Because of the considerable cross currency, that's actually 10.3% in dollar terms. So next year, we are looking at that coming off slightly, right? Like you said, one is the base effect. Two is that possibly there may be some slight, caution in spending. So we have estimated 12.5% in dollar terms growth for next year. And then FY25, we expect a pick up again to 13.1%. Now, if I look at consensus estimates, it's more around 8.3% dollar revenue growth for FY24, and pretty similar to that for FY25, which I think, from a 14% in constant currency to an 8% growth, that's a pretty sharp drop. We don't really think it will be that bad. I've not seen anything like this outside of the global financial crisis.
So you're saying for the next, say, 5 years, TCS can see, double-digit kind of revenue growth? Because it's not... Yeah, go ahead. Say 12,
sorry,
13%?
I'm just saying that I think that is definitely possible. I mean, 13% perhaps a little excessive, but yeah, 11-12% I think is a reasonable expectation, unless we see significant slowdown in the US, turned into a major recession. Unless something like that happens to derail spending plans, I think, with corporate balance sheets so strong, we've actually already heard Jamie Dimon talk about what, in the event of a US recession, what would he do? He said that he doesn't think that tech spend can be started and stopped just like that, just like you can't stop opening branches or hiring people. So I think large companies with strong balance sheet will continue to spend, and that's actually the clientele that matters most to Indian IT services providers. So I would expect this to be fairly robust, and this is a major technology refresh. I think the largest technology refresh in 20 years. So I think this is going to be a good cycle of 3, 5, even 7 years.
Okay, so you're still continuing to sound extremely optimistic. Also comment on the margins, because that is, of course, a big area where a lot of doubts are raised on how it could sort of pan out going forward. Your margin view, of course, is also extremely bullish. But how do you see it trending for some of these larger players, the likes of TCS, Infosys?
I think Q3 will actually be when we see significant improvement in margins. Q2, we, of course, still have cross-currency headwinds as well, and some of the companies still have wage hikes to deal with, like Wipro, for instance. But Q3 onwards, I think attrition should moderate. People will have some headroom in utilization to improve, and because we are seeing double-digit revenue growth continue, we think fresher intake can actually help moderate the average cost per employee and help margin improvement in FY24 and FY25. So I think margins are not a structural issue. It was a temporary problem. I think we are seeing attrition starting to normalize, the lateral hiring market become a little bit more rational. People are not trying to, I think, compete with each other, looking at the last offer that a candidate has got and trying to offer a premium on top of that, because that's not really sustainable. You have to attract talent based on, the strength of your brand and, offer a decent pay hike, but you can't just, have an auction of sorts.
Is it tough to convince your investors to buy IT now? Because the street is still divided, even after the near 30% decline from peak levels. And there are many brokerages who are very bearish. Like JP Morgan, for instance, has downgraded Indian IT. You're optimistic. How tough is it to, convince your clients to go out and buy Indian IT at these levels? And what is the pushback that you face? What are the key concerns in the pushback that you face?
The concerns are precisely what you raised, Rima, so I'm trying to address them best I can. And I think when I raise these points, people do say that this is fair, but I think most people have been hurt by the PE derating that has happened already. People do agree that it offers good value at current levels, and people are interested in looking at it. But I think people are waiting to see some signs of improvement in attrition, some margin improvement, all that. So I think it might be another 2-3 months before people really pile into this. Or I guess we have to see rupee depreciation. Otherwise, then this again becomes a defensive sector. Normally, it would have seen that impact already, but we had significant cross-currency headwinds dilute a lot of that.
And just for the near term, considering the tenuous macro environment, do you think there is scope for further PE derating?
I don't think so. I mean, if you look at, say, HCL Tech, that's a 4.6% dividend yield. I think, what's the downside from here? I don't see much. I think that's exactly the same. I mean, if you look at TCS, I mean, you're looking at free cash flow yield of 4% plus. So these are stocks that used to bottom out at 2% dividend yield. I mean, now we actually are significantly ahead of that, and we still haven't, seen people come and be very eager to take up positions. So I think it's just a matter of time, and people are just looking at the worries about the U.S. environment getting worse. I think when that clarifies a little bit, we actually will see people turn more constructive.
Ravi, thank you very much for making this appearance on CNBC-TV18. Look forward to more chats and conversations with you. Thank you very much for joining in.
Thank you so much for having me.
Get into a break. On the other side, we'll discuss what's buzzing in the commodity space. Manisha Gupta joins us next.
Hi, welcome back. You're watching Trading Hour. Let's shift focus now to the commodity space. Manisha Gupta is here, and today she's focusing on metals. Hi, Manisha. Morning.
Morning, Sumaira. Well, yes, metals have seen a bit of a rebound as the US dollar index rally has taken a bit of a pause. In any case, many of these metal prices were oversold, so there is some speculative buying as well, which we have seen come in case of metals. So whether it is about steel or iron ore, we have seen 2 to 3% of a rebound overnight into these markets, and Asia is trading on the positive side. There are statements coming in from China Zhengzhou saying that they will start rebuilding or building the stalled projects across cities there, and that would mean that some more construction material or metal demand will be on the higher side here. In the base metal prices, we have seen a rebound for aluminum, zinc, copper. All of that is trading up between 1 to 2.5%. Especially for copper, we saw the prices surge by 2.5% overnight as well. There are workers at Chile's Escondida mine which have voted for a strike. This is for the security reasons which haven't been passed by the employees, is what they are striking against. What we do understand is that there's going to be a partial work stopping from next week and complete shutdown in Escondida mine in Chile by the end of September. Chile's Escondida mine actually is the largest copper mine in the world, and that impact can be seen in prices. In any case, the copper inventories in Shanghai and LME have been on a decline, and the demand on ground seems to be picking up. That can be seen in the kind of premium that we have seen in many of these metal prices. The chart that comes on your screen clearly is about what we've done in this week itself in sense of metal prices. So as you can see, 6% of gains this week in case of copper, and that pretty much has been the case in other metals like iron ore, nickel, zinc, all of them closing this week in positive.
All right, Manisha, thanks a lot for bringing us that quick update on the metal prices. But with that, we're going to get into a short break now. As we do that, here's a quick reminder for our viewers. It is that time of the year again. Money Control Pro's financial freedom offer is back and with added benefits. So you can get a Money Control Pro subscription at net zero cost by claiming exciting offers worth rupees 1,500 from our partner brands. Grab the benefits now only on the Money Control app or website.
Welcome back. On the occasion of World Electric Vehicle Day, Tata Motors has announced the expansion of its EV portfolio. Will be launching Tiago EV. The company is also committed to launch 10 EVs in different product segments. Parikshit Luthra caught up with Shailesh Chandra, MD of Tata Motors Passenger Business Unit, and began by asking what kind of growth they expect from electric vehicles in FY23.
The journey in the last 3-4 years as far as electric vehicle car industry is concerned, I remember that in FY19 this industry was at about 2,000 annual sales level, and last financial year in FY22 it ended at roughly 22,000, which has been a steep growth, 10 times growth in just 3-4 years time period. So far in the 5 months of this financial year itself, the industry has done about 20,000 already, which is pretty close to where the industry was for the full financial year FY22. So I clearly see that the industry by this financial year end would cross 50,000 is what I anticipate, given where we have already the volumes that has already been attained by the industry in the first 5 months. So this is where I see the industry moving towards.
Right. And What about Tata Motors specifically?
So, we have been literally 88% of this market so far, and we have done about 17,500 kind of a volume. And we should also target closer to the 50,000 mark is what our effort would be.
Okay. What next after the Tigor and the Nexon EV? Are sub 10 lakh cars, are more affordable cars in the pipeline?
So, we had in the past talked about 10 products in the next 5 years, and we are very committed to that. And when we talked about these 10 products, it included 3 generations of our products, which is Gen 1, the typical conversion products like Nexon and Tigor EV. And then you have Generation 2 products, which are adapted ICE platform products, more electric ready, and new top hats like Curve coming on, that generation of electric vehicle technology from our side. And then there are pure EVs like Avinya coming from Generation 3. So this 10 will constitute to these 3 generations of products which will coexist at any point in time. But also it includes cars, which will be of widest range. When I say widest range, in terms of affordability, in terms of body styles, in terms of range and features that we'll give in these vehicles.
Your overall production capacity, to what extent is it constrained by the chip shortage? What is your capacity utilization currently?
Our capacity utilization, would be pretty close to 95-100%. For depending on which factory we are talking about. It varies from 90% to 100%. And there are certain actions that we are taking to further debottleneck to create some more headroom on the capacity side. And then beyond that, the Ford capacity will add to the existing capacity that we have. But right now we are pretty much close to 90 to 100% depending on which factory we are talking about. As far as semiconductor is concerned, while for certain components we have a challenge, but we are trying to mitigate that risk through other alternate actions, which we had been taking in the past very effectively. So we will be able to manage for those critical components any shortage that we might face. But there are about 5-6 items which we are closely tracking.
All right, so that's Sailesh Chandra, Managing Director at Tata Motors PV Business Unit. Remember, you can catch the entire conversation on CNBC TV18 and, of course, excerpts from this conversation all day today as well. For now, we're going to take a very quick break. When we return, we'll talk about the market technicals with Mitesh Thakkar of earningwaves.com. Stay tuned. Hi, welcome back to Trading Hour. Mitesh Thakkar of earningwaves.com joins in now for a quick tech check. Hi, Mitesh. How's it looking for now, and what's the trade on the index?
Yeah. So, the index has slightly tapered off after the gap up opening, but otherwise the trend remains positive. I think 17,750, 17,800 was some kind of a congestion zone. So we might give a mild pullback to about 17,800, 820 odd levels, but that will be a buying opportunity. So I'll remain positive on the index. My key optimism is coming from the Bank Nifty, which is, trading at, it's not at all-time high on an intra-week basis, but on a weekly closing basis, if we close here, that will be the highest ever weekly closing for the Bank Nifty. So both the indices look pretty good to me, maintain long positions. And on the Nifty, as I said, 17,800, 17,750 is the support area. As long as we don't go below that, maintain a positive bias.
What about stocks? Mitesh, what about individual stocks?
Yeah, I have a buy on Bandhan Bank, and that's again a banking name. Bandhan Bank has managed to get past some key averages. So that's a buy with a stop just below levels of 288.5 for targets of around 305, 306. And Amar Raja Batteries is the other one. That's a buy as well. Keep a stop below levels of 533. Look for targets of around 560.
All right, Mitesh, thanks a lot for joining us with that quick technical check on the market. With that, we're going to get into a short break now. But when we return, we'll discuss the fundamentals of this market. Devang Mehta of Centrum Wealth Management will be with us. Hey guys, welcome back. You're still tuned into Trading Hour on CNBC-TV18. For the market, it's still looking quite steady, around 70 points high. We've seen a little bit of a dip come through in the past few minutes, but we are still seeing gains of around 0.4%. But it is the banks where you're seeing a lot of the strength today come through. Let's invite a guest on the show to discuss the market. We have Devang Mehta joining us from Centrum Wealth Management. Devang, good morning and thanks a lot for joining us. So, the key theme that we have been discussing is this entire decoupling of the Indian market from what's going on globally. As much as we've seen sort of some nervousness and all of the fears of recession, inflation play out in the US, our market seems to just be moving higher. What do you expect from here on, and where do you think we can see the market head?
Good morning, Pavitra. Yes, I know that probably everybody is using the word decoupling, which of course I wouldn't like to use at this point. But for sure, I think Indian markets seem to be on a different tangent altogether. And there are, of course, reasons for that. So probably if a little bit of exaggeration is allowed, then it looks like an oasis in the desert, or a sort of a silver lining in a global dark clouds. And why I say that? Because at one point of time, just 2 months back, when crude was playing a spoil spot or havoc in terms of having an impact on the Indian economy and even the earnings of a lot of companies, now with Brent oil coming sub $90, I think a lot of Indian problems get solved. Input cost pressure for a lot of companies get addressed. 38% fall in the crude and trading around say $87, $88. Let's not get carried away. But even for this year, the average crude is around 105 or 100, around 100. And we know that every $10 fall will probably reduce the oil trade deficit by around $15 billion. So one can just calculate how it has an impact on inflation as well as the deficits. So my sense is, one, this is a very important factor which continues to dominate us. Second, despite dollar index continue to strengthen because of the lack of liquidity, a lot of other currencies like the pound or the yen would have touched your 25-year lows. But Indian currency, yes, of course, is also trading near its lows, but it's not been a sort of a havoc. You've seen currency relatively stable than the other parts of the world or other emerging market currencies or even developed market currencies. So I think these 2-3 factors are very important, plus Indian macros, story about the capex going on, $33 billion of outflows and just $7.5 billion leading to markets very close to its near highs. So my sense is the last leg of the rally has been fueled by crude prices, which has come down, a lot of commodities coming down, Indian markets, the Indian economy rather showing a bit of resilience, and also evidences of inflation coming down and a good monsoon as well.
Devang, morning. You started off this conversation by using the word decoupled. The markets may be decoupled in the near term, but India's economy cannot get decoupled from the rest of the world. The interlinkages are too many. So in reality, while the markets may decouple, it's very hard for the economy to be decoupled over the longer term. In that context, given what you're seeing, what are the risks for the market? And are we being a little too overconfident in the kind of resilience the Indian markets are showing right now?
Rima, very, very good question. In fact, yes, complacency shouldn't sort of set in. Such proceedings lead to a lot of people just behaving casually and buying everything and anything under the sun. So that should not be the approach. And as you rightly said, volatility is going to be the order of the day. As we all know that though market might decouple, but economies are linked. In the world of globalization, we can't have a economy which behaves parallelly different than the other economy. So you're absolutely right. Some of the sectors which probably get impacted due to a global slowdown, one needs to just take care of those sectors. As I said, global cyclicals like metals, some of the other companies which are linked. Indian IT is though very competitive. Indian IT benefits from at least a lower rupee. But most importantly, what will happen is whether there are order cuts, whether there are margin cuts, whether the attrition issues come to the fore, or even lateral hiring, does that stop? All these are certain questions which one need to ask for certain sectors. But yes, most of the Indian IT companies, I think, are extremely competitive. So this might be a passing phase. But to answer your question, yes, one must not get carried away by such a rally. And one has to just follow a lot of macros along with a lot of micros.
So Devang, domestically focused themes and sectors, what would be your preference?
Sumera, at the expense of sounding cliche, we have been favoring this one sector, which is sort of building materials or home improvement. And most of the companies in this universe, or most of the subsectors in this universe, have seen sort of not only demand coming back. And in India, if I can say, home improvement or building materials is more a consumption sector rather than sort of a very deep cyclical. It might have some shallow cyclicality, but a lot of this, as I said, subsectors like paints, adhesives, ceramics, cement, fast-moving electrical goods, all this find favor with investors. Because all these companies are branded. Most of these companies have pricing power, except for cement. Most of the sectors, as I said, have a lot of pricing power, a lot of moat along with the proceedings, high ROEs, and they have good pricing power, which we have seen companies like Asian Paints, Pidilite taking hikes anywhere between 20 to 35%, and stock prices also behaving in sync with that. So my sense is that the building material is one sector which one can't avoid. I was looking at an interview in the morning. Federal Bank CMD on your channel was talking about never seeing such type of credit growth for the first 120, 150 days of the fiscal. And all the SMEs and corporates are sort of lining up for brownfield, greenfield projects. All such things prove that a lot of capex is going to probably come into the economy. So BFSI as a sector, capex or capex ancillaries, all these companies, automation companies would find a lot of favor amongst the investing community for at least the next 2-3 years.
All right, Devang. So we take that point. You like BFSI, you like capital goods, building materials as well. These are some of the sectors that you favor. Thank you very much for joining us today and taking us through all of those ideas. With that, we're going to get into a short break now. But on the other side, a whole host of new releases are lined up in September. This is a whole host of movie releases that we're talking about. We will take stock of the cinema space with Karan Taurani of Elara Securities when we come back.
Welcome back. Markets are in fine fettle. We're still up close to about 1.4%, though we have slipped a tad bit from the top of the trading session, especially the mid-cap index. If you could get that up for you on your screen, the mid-cap index has seen a fall of close to about 150 points from the top. There you have the mid-cap index. But let's talk about, finally, there is a big Bollywood release. The highly anticipated Ranbir Kapoor and Alia Bhatt starrer Brahmastra has hit the screens. We're now joined by Karan Taurani of Elara Securities to help decode what it can do for the multiplexes and more. Karan, thanks so much for joining in. Have you managed to catch it yet?
Not yet.
Okay, so you're going to go by the reviews which are there on Twitter.
Absolutely. I think the reviews have been mixed so far, more trending towards the negative.
So, the multiplexes, Bollywood itself has gone through a big lull in the last couple of months, and Brahmastra was expected to break that. Your thoughts, can it do that?
Doesn't look like, as of now, if you look at the trends in terms of reviews, it's been more negative than positive. Actually what has happened right now that in terms of estimates for this film as well, we are anticipated a wide range of box office collection lifetime, being in the range of 130 to 190 crores. So if the word of mouth is good, the film would have, breached 180 crores kind of a number. Because we did see very strong openings, for this film in terms of advances. I think the day one collection could be in the range of 25 to 30 odd crores. And that's primarily been, because of the buzz that film is. It's a different kind of a film. It's a large franchise film. But it purely depends, tomorrow onwards in terms of, how the numbers really trend. And as of now, I think it's mixed, signaling more towards the negative. So we might end up, somewhere towards the lower end of our estimate.
I think we should pull up the stock price of PVR and Inox. Karan, as you speak, you are seeing a negative reaction in the stock price. So PVR has slipped close to about 4.5% from the top of the trading session. Inox Leisure 2 is down close to about 3.5%. You were anticipating a pickup in occupancies. How would this change your Q2 estimates for PVR as well as Inox?
So I think in terms of, purely box office revenues, we were expecting a decline of 40% plus. I think the month of July and August have been very dismal. The content has really not picked up. In the last, I think, 6-8 months, we have seen close to 12 to 13 large films, which have really bombed at box office. We've seen 7 to 8 medium budget films, which have not done well at all. So I think we were anticipating that, this quarter will be a quarter which will be the worst quarter, for the exhibitors in the last 5 years. And that is where we are heading towards. But if Brahmastra, ends up towards the lower end of our guidance or probably even lower than that, this could be the worst quarter even beyond 5 years. So I think there are concerns in the near term because of, the content not doing well. But I think, this recovery will come back very sharply. I'm anticipating that, Q2 FY24 onwards, we are going to see a very sharp recovery in terms of box office. And a lot of things are going to change here. We've seen this in the past as well, when you saw Bahubali 2 releasing, a lot of the films actually flopped, on a back-to-back basis. But then you saw the entire change in terms of scripting, in terms of story, direction, because the content, because the audience preference, keeps on changing in terms of content. So I think they will make a comeback. It's a matter of time. I'm not expecting that, Hindi's content is going to go anywhere. It is very much here to stay.
Karan, did you say Q2 of FY24? Because that is a while away.
Yeah, I'm saying Q2 FY24. So basically what I'm talking of, films, doing consistently well as they were doing pre-pandemic days. I think that is how it's going to be. So currently we do have films. I mean, there is Vikram Vedha, which looks promising. There is PS1. There are some more films, Ram Setu, which is coming, around Diwali time. So there could be some positive surprises, the next 2-3 months as well. But, films doing well back to back on a consistent basis, like how they were doing the pre-COVID days, I think that is still some time away, because whatever content we are going to see right now is backlog content. And all this content was, conceptualized and created, 2.5-3 years back. And what the pandemic has actually done is that it has actually exposed the audience to a lot of new type of content, regional content, dubbed content, wherein the audience is really wanting to watch that kind of stuff, which they did not earlier. So I think the taste preference are changing, and basis that the industry also needs to change themselves. It's a transition phase, and it's a cyclical industry. I mean, these kind of cycles do keep coming and going. So I'm very confident that, next year, towards the second half of, CY23, there's going to be a very strong comeback for Hindi box office.
Okay, but this current quarter is going to be the worst, perhaps, in the last 5 years. That's your anticipation. And July and August occupancies, as you pointed out, are very, very low. Just about 20%. Is that the number that you anticipate for July?
It is sub 20%. It is sub 20% for July and August.
And September?
Yeah, and I think with September, I think if Brahmastra breaches that 180-200 crore kind of a number, I think occupancies will move towards 28 to 30%. But that looks highly unlikely given the initial reviews as of now. And we might see, September month also having an occupancy of 18-20%. So which means that this quarter will be a quarter where, the exhibitors just about breaking even in terms of EBITDA margin. And what this does is, this is just box office revenue. This has a huge spillover impact on other metrics. So your SPH, food metrics, ad revenue, it has a huge spillover impact. So EBITDA margins could actually trend much lower as anticipated.
Okay, so Karan, in this context, when you're saying that this quarter will definitely be the worst and recovery might take a while as well, right? You were saying FY24, Q2 of FY24. In that context, how do you look at a few of these stocks? Because, I mean, if this kind of pressure could persist for some time, and right now we're talking just about the box office. You yourself mentioned that, of course, the food revenues, advertising, all of that also comes into effect. How would you look at the stocks in this context?
So I think, from a stock standpoint, there is a negative implication in terms of near-term weakness, which one cannot, debate about. But my only point is that there is a merger, which is a big trigger. And I think that is moving fairly fast. We saw exchange approval coming in much earlier as compared to Sony in terms of the merger. So I think if the merger process actually comes up and moves at a faster pace, that is going to be a big trigger for the stock, because there are ample synergies, right from advertising to convenience fee put together. And the stock prices have corrected. I mean, if you look at PVR Inox, last month, they have already corrected almost about 15 to 20%, which was factoring in this weak quarter. And, around the month of July is when we raised a warning signal that this quarter will be one of the worst quarters. So I think prices right now are, at a reasonable valuation. They may have a 5-10% downside if things go worse from here on at max. But I think the potential upside from medium to long-term perspective is very great. So I am not, I have no issue in terms of the future of cinemas. So the future of cinemas, future of Hindi box office, the film industry is very bright. This is just a cyclical trend, which is kind of impacting performance right now.
Well, no, we're not questioning the future of Bollywood in the long term. We're just talking about the near and now. And
maybe whether we should catch Brahmastra today
whether you should catch Brahmastra today or any time.
Yeah, well. And it seems like our ticker team is really trying to talk to us. The stocks have slipped further. So take a look at PVR, Inox, both of those slipping even further right now, down around 4% on each of those counters.
Did you catch the movie?
I'm not too keen on it, to be honest, but I think you should answer that question.
I'm just waiting for the real reviews to come in.
Yeah.
I'm not convinced about day one reviews, so I'm going to wait for the reviews.
All right, so we'll wait. Bye. For now, the stocks of both of these companies are under pressure right now. So let's see how it pans out. And with that, we're completely out of time on this edition of Trading Hour. Thank you very much for tuning in. Halftime Report is up next.